Money. Money.
Sometimes during Money Chat, I talk about credit. I talk about financial tips, but today I'm going to talk about my own personal arena, which is mortgages. So a lot of changes are happening in the mortgage industry, and there's been a lot of changes since the financial meltdown in 2008. I want to just kind of start there. If you think about it, would you want to relive the crisis that we went through? I bet your answer would be no. So let's start out with why we're in the situation, or why we're in the regulations that we are right now. Before things were set up in being regulated with the lenders got to make their own rules. Banks could decide what they wanted to do and how they wanted to lend. That didn't work out so well for us because we had a financial meltdown. It was a disaster, and I think everybody, I don't know anybody that I've talked to, including myself, that was not affected by that. So when the government stepped in, then they decided to put together some regulations and rules that now all lenders and banks have to follow, set up by Fannie Mae and Freddie Mac, which the secondary market is owned by the government still, and they decide what needs to be completed in order to be in compliant for mortgages. Now, since the crisis, there's been constant changes and updates and more documentation. And we just recently had another one that's coming into play. It's supposed to hit August 1st, but there might be an extension on that, which would be a little bit exciting in the mortgage arena. But if just think about it, when you're asked for a lot of documentations, which you will be, when you kind of think the process doesn't feel like it's too much fun, which it will not be, just look at the positive side of it. If we weren't in this environment, we could be at risk of having a financial meltdown again. So we just want to make sure that everything is getting verified, things are double checked, the T's are crossed, I's are dotted. So I want to go through some tips to help the process be successful. Now, I just gave you tip one, really, is just understanding what's happening in the mortgage industry. Not really worrying about why things are being asked for, but the fact that they just need to be, or they're required to have them. The bank is not making up, again, the regulations are asking for the documents because they don't have to. The underwriter is not just asking for documents. It's because it's a requirement in order to close that loan so that they can continue lending to new homeowners. So get all the documentations that are documents that are asked for. Understand, too, that you want to expedite and turn things around as quickly as possible. So as documents are requested, same day, if you can do that. If not, by the end of the next business day. Anything longer than that, you're going to start having some issues with the timing and the closing timelines. And the reason why is because things are moving really, really quickly, but there's additional documentations that are still being requested. So updated documents, just keep everything that comes in from the time that your offer is accepted, or from the time that you get pre-approved before you make an offer all the way until closing. Keep all of your documents because you have to continue to update the documents all the way through the closing period. So there shouldn't be a reason that you should be asked for a pay stub right at the closing table, because if you know up front that you need your pay stubs all the way through the end of the closing process, you should have already actually scanned and emailed that document over. So just keep sending all the updated documents, updated asset documents, updated pay stubs, anything that comes in, send those over. New debt or credit cards, you don't want them. You don't want to open any new types of credit at all. Even if your mortgage consultant congratulates you on such a low debt to income ratio, which means the bank will lend you a lot more money than what you would actually spend, which that can happen because the lender is lending at a 45% debt to income ratio. So they're very forgiving on debt to income ratio. So maybe you're approved at $500,000 and you're buying a $400,000 home. It's not uncommon. Even though you have that room in your debt to income ratio, you do not want to go out and incur new debt and especially open new cards because it triggers to go back in an underwriting stage. So if they see that you've had a big purchase on your credit, or that you've actually opened a new credit card, at the very end of the process, what's called a soft pull. A soft pull, your credit report is pulled. Hard pull meaning it affects your credit score. Soft pull, it does not. So they do a soft pull credit as soon as the documents get back from ESCO to ensure that there's no new debt or big purchases that you've made. So if you have, it's going to step you all the way back to the underwriter process. So what that means is you're going to be okay debt to income ratio in this example, but you're not going to be okay on your closing date, and the loan is not going to close on time. So what happens if the loan doesn't close on time? Then you need to get permission from the seller to extend that closing date. Now, I don't know in this market if you can have any guarantees that the seller is going to extend the closing date, because maybe there's another offer behind you that's willing to pay more money than you've already agreed to on the contract. Maybe you've already released your finance contingency, which means that earnest money that you put down, actually, they could keep it if they don't want to extend the closing date. So it gets really tricky in not being able to meet those commitments. Now, obviously, in not incurring new debt, if in another example, you're at a close debt to income ratio, you don't want to push that over. So no new debt at all. No, don't open new credit cards. And I know it's kind of tempting because you've just purchased a new home. So there's a lot of cards out there. You get free interest, and at the furniture store, if you put it on credit. So go ahead and open the credit card and get that free interest and get your new furniture. It's not something that you want to do. Next is life changes. So life changes, job, profession. If you're thinking of making any changes, not to say that it would be an issue, but it could very well be an issue and a big issue. So you want to check with your mortgage consultant first before making any employment changes. So things that come into play that could be a challenge is the timing of it. Again, if you're making an employment change during the closing process, you won't be able to provide a paycheck prior to closing. That can be an issue depending on the type of loan that you're going with. If you change from one industry to another, if the comp structure and how your pay changes, there's a lot of different things that could be affected by making a job change in the middle of the closing process. Also getting married, hopefully you're not getting a divorce during a closing process, but life changes. You don't want to make any type of life changes without checking with your mortgage consultant first to see how it's going to affect the closing process. Deposits. This can be a big part of the inconvenience of documentation. Is any money that's coming and going from your accounts have to be documented. So you want to be really careful with making sure that you're communicating with your mortgage consultant money that's coming in and out of your account. Now, what I'm talking about is things that are not direct deposits. Obviously, if your paycheck is direct deposited in your account, if you've had money coming in that you are transferring from one of your other asset class and it's directly depositing from one account to another, that's an easy paper trail. You don't want any cash deposits. If you loaned some friends some money and now you want to get it back because you're buying a new house and you want to buy that new furniture or those new appliances, you want to wait. So just knowing that anything that comes into your account has to be documented and paper trailed. And a paper trail just means it comes from an acceptable source of either gift funds from your family member or money that is your own funds. Now, a lot of times you may think selling something would be considered your own funds. It actually isn't unless you can paper trail it. So you can't just go sell a car and say you sold a car. You've got to go through and show the title, show the blue book value. So there's a lot of documentation and paper trail involved in that. Liquidating funds, just again, this kind of goes into the deposits into your account as you're making liquidation of any funds. Just save all of the documentation and paper trail of doing that. Sometimes people, first-time homebuyers especially, are borrowing from their retirement funds for down payment. That's fine, but you just need to be able to paper trail and save all the documents. Also, that the paper trail is important when you're getting gift funds from a family member. So depending on what type of loan you're with, and this is a conversation you're having with your mortgage consultant, on government loans, you have to be able to verify that the donor, the person that's gifted you the funds, have the ability to gift that money, which means that you're going back and actually paper trailing their accounts. So not only are you showing where the money came from and the paper trail from their account into your account, but you're also showing the history of that donor's account that goes back 60 days. So that can be a little tricky if you're not communicating and having these conversations with your mortgage consultant up front. Signing date and closing cash that you need to close. It's always a good idea just to know your figures are going to be within a few $100s up or down. You don't have the exact dollar amount until you get a call from escrow, but it's pretty regulated, so you're not having additional fees that are surprised and popped in there anymore. That went away after the crisis, but it's still, there can be a few $100s here or there. So just know that, and you don't have the exact dollar amount until the time that you're going to go in and sign. Now, unfortunately, you don't know the exact date that you're going to be signing because everything everything happens at the end of the process. So typically an escrow company is not going to pre-schedule a signing. They're going to schedule a signing once the loan documents are actually in their hand. And the reason why is because the lending industry has not done a really good job with under-promising and over-delivering, but over-promise. They've done a really good job with over-promising and under-delivering. So letting the escrow company know the documents were going to be there at a certain time, then they don't actually show up. And so the escrow company would have to reschedule. Now, so because of that, the escrow companies wait to get the scheduled signing on the calendar until they have the loan documents in hand. So just let your employer know, typically your signing is going to be anywhere from 2 to 3 business days prior to closing. That actually going to be changing with some of the new regulations that are coming in. It's probably going to be 5, maybe 6 days prior to closing, maybe even 7 days because of the waiting period that's going to be coming up. But you just need to let your employer know up front that you're going to have some time off, but you're not really sure when it's going to be. So as long as you can prepare for that, it makes it a little bit easier. When you do go to escrow and sign your final paperwork and bring in that check, it is going to be a cashier check or wired funds. So you want to make sure that you're not coming in with a personal check. If you're doing wire funds, make sure you're checking with the escrow company to find out, or checking with your bank as if there's any hold on those wired funds, because that could be an issue for timing as well. And then a spouse, if you're purchasing a property on your own, or for some reason a spouse is not going to be available possibly for signing, maybe they traveled for business and there's no way that they could know for sure that they're going to be in town unless you give them an exact date, then you can set up a power of attorney. If you have a spouse that's not going to be on the loan, you could set up a power of, or if you have a spouse that's not going to be on a loan, you have to know there's going to be certain documents that they actually have to sign. So just communicate with your mortgage consultant, have a conversation about those as well. And then last, if you plan on taking any trips outside of an extended weekend, like the 4th of July weekend, everybody that's in process to close, it's okay if you're going to be taking a three-day weekend. But other than that, don't leave town during closing. Make sure that your vacations are scheduled after you move into your house or before you have an offer accepted. If not, you need to communicate up front and what that's going to do for your closing date, because you need to make sure that you're available during the closing process for any additional documentation that's going to be required throughout the process. So that's just a little tips on the closing process to give you an idea of what you can do as a consumer to help up front. Know the right questions to ask your mortgage consultant. If you're working with somebody established and good in the industry, they're going to be having this conversation with you. But it's kind of nice to give a little bit of a reminder of those tips out to any of those of you that are purchasing a home. If you have any questions, as always, you can feel free to call into the show at 1-855-400-1150. Again, that's 1-855-400-1150, or online at themoneyhour.com. Coming up next on The Money Hour, real estate's a hot topic today, and there's a lot of advice on how to navigate through the environment. But the wrong advice could be the biggest financial mistake that you make. So you want to have someone that knows what they're talking about and an expert. That's who I have in studio, Eric Tinglam with Trident Real Estate Realty Group Northwest, right here on 1150 AM KKNW after the short break.